G'day folks, welcome back to another update for natural gas. Now the charts are showing bearish momentum still, although we do have a bullish divergence on the daily chart. Before we go any further, make sure you hit that like and subscribe button. Now we did do a video a few days ago for commodities. That was done on August the 25th, so that covered natural gas there, but we didn't cover the ETFs along with the other commodities. So have a look at that video if you missed it. But again, don't forget also, we do a +1 video series where we look at a deeper dive into various strategies. So have a look at that again for any strategy advice. Now, in terms of the outlook, Europe facing heightened energy security concerns due to Russia's supply restrictions and Ukraine's transit halt. LNG imports have become critical. For Asia, prices remain elevated, suppressing demand despite seasonal upticks in imports. Europe outcompetes Asia for cargoes. For North America, abundant production, expanding export infrastructure and growing domestic power demand create internal dynamics that could influence export pricing. For Canada, gains traction as an LNG supplier, offering alternative routes to Europe. Geopolitical events, tensions between Israel and Iran and Washington, Moscow energy negotiations maintain global risk to supply stability. And for Australia, despite surplus, may need LNG imports to serve domestic demand, particularly in Victoria and New South Wales, reflecting infrastructure rigidity. So I'll start off with the natural gas price. So on the weekly, first off, the price on the price are below the moving averages, giving us a bearish outlook, as you can see. Likewise, the CCI1500 is also below the moving averages, so bearish momentum on the weekly. Before we leave the weekly, just for a moment, let's zoom out and try and identify any divergence. And you can see there's no divergence. The last one, the major one we saw in the weekly was back here, declining highs on the CCI versus high highs on the price, and that fell off quite strongly back in 2022. So always pay attention to divergence. That was the weekly. So at the moment, bearish momentum. On the daily, work backwards, we've got here currently the price is touching that moving average band, with the CCI showing us a consolidation. Now notice the moving average bands on the CCI, they're very constricted. So what you want to see is ideally the price ebbing and flowing above and below like they were back here. That's where you would have gone long and you would have gone short there, and probably there you would have closed out your short positions, going short there when both the price and the CCI below, and so on. So when you see a consolidation like this, it's probably wise to either stand aside, don't trade long or short until we see a more decisive break and you see the moving average band widen. And that's why I use the moving average bands instead of one single moving average. On the price though, it's still declining, so still bearish momentum predominantly. But again, just notice we might be seeing a bit of a bounce here. And I've got a little bullish divergence there, double bottom on the CCI versus lower lows on the price. That's a bullish divergence. And if I was to draw a Fibonacci target range, again, I don't trade these targets. I look at areas to get out of if I was going short. So you should be out of the short trades at the moment if you're trading on the daily. Now, if I pull the Fibonacci's back to that high, which is the high you have typically before the divergence started, you can see there, if I draw a target range between that 23 and 38% range, is just shy of that. So it might hit that in the coming hours. But again, just be careful of that. And if it does go through there, then we'll look at the next level of Fibonacci, which will raise it to there. So again, we might see it break up to the upper band of that smaller range, or even start to the lower band of this higher range here. But at the moment, we'll leave that lower range there as a potential retrace. Again, it could go a lot higher, but we can't tell at this point. That's the daily, so neutral positioning on the daily. On the hourly, again, we're looking for any divergence, working backwards. You can see there the CCI is moving in tangent with the price. There's no divergence. But at the moment, the price is above the moving averages. The CCI is broken into the moving average range. So you're seeing a bit of a weakness at the moment. So you might see the price pull back possibly in the coming hours before making further upside to, as I said, break into that divergence range. Now, if we zoom out on the hourly, what we're looking for is any divergence, just historically, just to show how it worked. And back here, we had higher lows versus lower lows on the price. It had a couple of points there. You can see there, a smaller one there. And in fact, if you stretched, actually leave that there, if you stretch this one to there, that's still a higher low versus the same period, lower lows on the price. So again, that's similar to the daily chart in terms of a divergence. So if we were to draw a Fibonacci from that low to that high, you can see there, it's already hit that 23-38% range and currently sitting around about the 38% range at the moment. So that's how we read that. Now what I've got here, let me just get rid of that divergence, that Fibonacci for a moment. We'll go to the back test, and this is the daily and this is the hourly. So on the daily you would have gone short once the price broke below the moving average, and so was the CCI. You would have started taking short trades, and that's where I've marked this back test from that period on the 1 hour chart. And again, this strategy, the CCI 14, the CCI 150 and the moving averages are in the description below if you want to learn how to trade this strategy. But basically whenever the CCI 14 breaks to the downside and the CCI 150 and the moving average of the price are in a downtrend, you take short trades. You can see there it had a few little short single trades there, short trades. This one averaged down because the price is going against you. But then notice here again, we had a bearish divergence and the price broke down again. You would have started taking some short positions again during those downtrends. But at the moment, notice again, you had a bullish divergence here on the 1 hour, as we said, and ideally you'd be closing out your short trades and taking your profits off the table. So for BOIL on the weekly, it's a very flat consolidated period down here over a number of years versus a bullish divergence, and that actually broke up very, very slightly, nothing too dramatic, but then now both the price and the CCI are broken below the moving averages. On the daily, zooming out, you can see there again there's a consolidation with the price still declining. So again, be cautious, don't go short until we see this break further to the downside and you see those moving averages start to widen. That's how ideally you'd like to see it. But again, bearish momentum, I'd call it neutral at the moment on the daily. And if we go to the 1 hour chart, what we're looking for working backwards is any divergence. You can see there very clearly you've got a bullish divergence versus lower lows on the price. That'll actually extend to that period. So at the moment, again, looking at a potential bounce, I think we marked that area there. That little range there needs to drop down to that point there to be more accurate in its target range. That's a 23-38% as a minimum. We see it bounce there as well. It could go a lot higher and very likely will, but at the moment, that's our short-term divergence target. Now that's on the 1 hour time period. If we go to the back test, again going short here for when the price broke below, and so did the CCI, below their respective moving averages on the daily. That was on the 20th of May. That's indicated by this period. You would have taken short trades only. Again, looking out for any bullish divergence to close out your trades. There were a few times it averaged down here, a couple of times there, and there. But overall, it did quite nicely going short with 1632 in trade returns. Next, we look at UNG. Now, the UNG, again, that's showing short positioning on the weekly, both the price and the CCI below the moving averages. We did have a bullish divergence here. It looks like it bounced slightly, but then it proceeded to break below those moving averages, as I said. So bearish momentum at the moment on the weekly. On the daily, it's just broken below that support we had at 1242 previously. But notice the CCI is consolidating similar to the other charts with the price still below the moving averages. So I call it a neutral positioning. Just wait for I wouldn't be going long yet until we saw a significant break above those moving averages. And ideally, I'd like to see the moving average band widening between the blue and the red lines like they were back here to be more bullish. At the moment, still predominantly bearish on the price, but neutral on the CCI. That's the daily. Going to the 1 hour chart. Again, here we've got a bullish divergence versus lower lows on the price, and that'll have to readjust that Fibonacci from that point, take it back to that high, and that'll mean we have to change eventually. We have to change that target range, the 23-38% range. So remember, whenever you get the extension of the price and the CCI showing an extension of that divergence, you have to readjust the Fibonacci like I just did then. Going to the back test, again starting back here when the price below the moving average, and so was the CCI. That was around about the 15th of May, coincided with this period. Going short only, no long positions to be taken. You would have taken short positions during this period. Let's get rid of that. And as I said, you've got a couple of divergences to look out for there, a bullish divergence there and there. You would have closed out any short trades at the latest during those periods and avoid going long. And you've got the latest one here, the bullish divergence, and you would be closing it out probably about now, I'd say. Whenever you see a break above that moving average, probably even back then when it broke above the moving average of the low there of the CCI. But that generated about $1,400 in returns for UNG. Lastly, we'll look at KOLD. Now this is the inverse chart, obviously. So we've got the prices above the moving average on the weekly, and also the CCI broken strongly above. So bullish momentum on the weekly. On the daily, we've got likewise bullish momentum on the daily price chart, although notice it's pulling back towards that moving average. The CCI has already broken into that moving average range, so if you're going long during that period, you would have closed out your position on that candle. And there was a bullish divergence here, ever slightly, probably a very slightly higher low on the CCI there versus slightly lower lows on the price, and that's still a bullish divergence, and that broke well above the Fibonacci range of 100% on that one. But depending on where you drew the Fibonacci, looks like it's gone to about 100% on that one as well. Now if we go to, that's on the daily chart. If we go to the 1 hour, again what we're looking for is any pullbacks. So if you're going long at the moment, again you would have been paying attention to that bearish divergence there. That would have closed out that position there, possibly re-entered another trade there in those hours, and then closed it out again as soon as it broke down. So you would have made a couple of pips on that little period there in those hours of trade. At the moment you wouldn't be going long or short because the price is broken below the moving average, and so is the CCI. Now if you look at the back test, what we've got here going long from the 25th of June when the price broke above, and so did the CCI. Now this is a bit of a tricky trade because notice here the CCI on the hourly and the price were above the moving averages. You would have gone long. It's a bit hard to see, but there is a trade in there and a couple of trades in there, and you would have kept going long and closing it out whenever you see CCI break into that moving average range. That would have been closing at that level there. Avoid going long. I'm following the CCI at this point. Go long there when the price and the CCI are above the moving average. Close it out again there. Again, notice very small gains. We're trading $5,000 lots on KOLD. Now this one had a bit of a drawdown. Notice again the CCI, it hovered above the moving average range, and you would have closed it out on that point there. And that was generating about $991 at that point if you let it run through that period to that point there. Notice that was the CCI broke into that moving average range, and at that point the price was near, it's a bit hard to see there, let me just zoom in a moment. The price was near the top there for you. So if you closed that out when the CCI broke into that moving average range, you would have closed that out on that candle. And at that point it was generating about $1,000 in revenue on the equity curve. Now obviously during this period the backtester kept averaging down, and you would not have been into this trade at this point because you'll notice the price was declining, and so was the CCI. So you would have been wise to take your profits off the table at that point. Nice little return, $1,000, not too bad, and avoid with that drawdown. Now, sometimes these backtests can be deceiving because it looks like it's a very profitable period of trading. Had you stayed in the whole period, you would have made $29,800. But again, that's a bit of a risk because what you're doing is you're going against the trend on the hourly. Let's see what that looked like on the daily. You noticed there on the daily, you would have closed out your position on that candle. And that, if you look on the right where that vertical line is, that equated to this period back here when the price broke below the moving averages on the price and the CCI. So you would have got out somewhere there with about $900 in returns, and you would have avoided that drawdown. But what it eventually did, in this case, it worked out quite nicely, but again, you didn't know at this stage. But there was a bullish divergence there. As soon as you saw that, you possibly could have got back in a trade there, and that was a nice little trade to the upside. And again, closing out whenever it touched the moving average of the CCI. Again, notice here we're getting lower highs on the CCI versus higher highs on the price. And again, probably would have been wise to close out positions if you're already in long positions there. If you prefer trading shares, reference the Patreon channel on the Patreon page where I look at weekly bullish share scans across various regions of the world's markets. Thanks for watching. Hit that like and subscribe to support the channel, and I'll speak to you in our next video.